Too many people were expecting the Big Short 2.0 and of course the financial crisis 2.0, but this time around it's very different. We are seeing a very different world until this moment. You came here for the truth, so let me unveil that for you. In today's video, I want to outline what's going on. I want to give you it because I think you can handle the truth. Can you? I'll show you this. Bank credit is shrinking for the first time since the Great Recession, and that's a red flag for the economy. So this is just one part of the puzzle. I'll give you more, but let's start here. Bank credit is seeing a sustained contraction for the first time since the Great Recession. This means that businesses are borrowing less as high interest rates chip away at confidence levels. The US economy avoided a recession last year, but investors are still pessimistic. So when we look at this absolute fact, well, we got to understand that if there aren't enough loans going out, if there isn't enough cash being dispersed, if that liquidity isn't there, then things start to topple. And this has nothing to do with the market necessarily. I'm not talking about stocks. I'm not talking about your 7 shares of Amazon. I'm talking specifically here at bank credit. And it remains to be seen of where this will go in the next while. But just understand that this does not happen often. Okay? Look at this chart. You can see it for yourself. Okay? It is a rare occurrence indeed. Now, we've just begun. But just judging where it had been previously, it's been going down, 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 down. All right? And the expectation is that at least for the next little while, that will continue. Why? Well, because interest rates, even if they start to cut or signal maybe they're going to cut, we're still deep into it. Okay, we're 5.25% to 5.5% on the Fed funds rate. If they start to cut, okay, we come down, we're still 5%. And maybe we get 3 cuts this year, okay, we're still, let's even say 4.5%. That's still higher than where we've been for a very long time. So just assuming that things are going to, turn around, everything's going to be great tomorrow, I think we're missing the point here. They want cheap money. They want that stuff thrown out onto the streets from the helicopters. But I don't see Ben Bernanke. I've been using my binoculars and I've been looking around looking for Helicopter Ben. Haven't seen him. Oh, we'll get there. We will. But not yet. Okay? Keep that in mind, all right? Traders give up on a March rate cut, by Fed as bond market inflation expectations move higher. We don't know what's going to happen, but the market with futures and swaps generally do a much better job of predicting what's going to happen versus, looking at quite the opposite, okay? When we look at the traders, the investors, the pundits, they don't do a good job, okay? And even the Federal Reserve themselves. So the market has been highly accurate. I don't know what's going to happen exactly, but I can tell you something that we're going to find out some information very soon. Very soon. And I think the first action that they take, we'll see if I'm right, the first action that they take is reducing the quantitative tightening. So they're doing $80 billion of quantitative tightening per month. And it seems likely that they're going to reduce that. Let's say we go down to 40 billion, or they do it in steps. So from 80 billion, 60, 40, 20, and then they stop. So that will be a gradual reduction. And it's kind of a pivot, in a sense, part of this pivot. It's the slowest pivot you're ever going to see. It's the Titanic. Think about it. Iceberg ahead. We see what's happening with bank credit. All right, time to turn that ship. They're turning. But that's a big boat. Iceberg's coming, but we got a big boat. So we're turning. We're doing all these different things. We're going to start saying it. We're going to start to say, we at some point want to cut interest rates, want to stop all these things. That's their first thing, calling it out. The next thing is to reduce the amount of quantitative tightening, eventually stopping it altogether. And then, of course, rate hikes. All of these things need to come into play at some point, and we could see a lot, or depending what happens exactly, these things will come into play this year. Okay, so we're going to see how that unfolds. That's the situation at this time. Inflation at 3% isn't the problem. It's the expectation that interest rates will soon fall. Asset manager says, my goodness. All I wanted to show you was that the market can't make up its mind. Okay, investors can't make up their mind. They don't know what's going on. They don't know. They just want to hear from the Federal Reserve. They want to hear from Jerome Powell that everything is a-okay. Just keep that in mind, okay? The $8.8 trillion cash pile that has stock market bulls salivating. Wall Street hopes trillions in money market funds will flow into the stocks and bonds. Investors have varying plans. That's where we are. Just know that, yeah, there's a lot there, but it's not as if all of that is going to somehow come out into the stock market. Like people love money market funds. They're very popular funds, in fact. Why? You put them over there, you leave them, it's liquid. If they need that because suddenly they want to go on a vacation, they could pull that out. If they need that because they want to dump it into stocks, they can do that. It's basically just a cash account. Think of it like a cash account. You always need some cash handy. They don't necessarily want the cash in bills. They don't really want to put it in their savings account, but they want that cash. So they put it in money market, okay? So just understand that don't think that $8.8 trillion is suddenly going to deplete and go down to zero and go into Apple stock. So it's not going to happen like that. So just be aware of that. The point, though, is some of that, if they feel confidence, will in fact go into the market. So there is some cash that could be coming. And where does it want to go? Obviously, it wants to go into the Apples and the Amazons and whatever, Nvidia, all these things. Nvidia being more valuable than, I mean, you just look at some of these companies, it's more valuable than it's crazy. It's great. Real strong companies too, more valuable than that. Yeah, I guess maybe it's the leather jacket on the CEO. I don't know what's doing it for them, but here we go. Number of mentions of generative AI related topics in corporate transcripts for the Russell 3000. Are we past the peak hype? Certainly we are past the peak hype, but we will continue to hear about it over and over and over again. At this point, companies are just like, okay, just show me something that's like not just some cool stuff, okay? I don't want to see some Jerome Powell thumbnails of this and that. Like, that's not what we're after here. We're after, like, can we actually fire a whole bunch of people? Until they get that, that's going to sort of wean down slowly and slowly. Okay, we don't really care about that stuff anymore. They want to see firing people. When do we get that? That's when the market will love it. Okay, markets love firing people, by the way. If you haven't figured that out, it is an absolute fact. It's just a fact, okay? And the BTFP, so here we are coming full circle. BTFP, part of that, when you look at the reduction in credit and so on, BTFP, Bank Term Funding Program, the emergency loans, that's mainly, by the way, the big banks are using it because they can make money from it. But the small banks, the regional banks, are actually in a very dangerous territory. And they've got a problem because they don't have enough assets on hand. And so they are really relying on this. And guess what? March, BTFP is over. So we got a problem as of March, just to be clear. Looking at this, the deposits have started to come down in banks. And I'm wondering where this cash has started to go. Is it the stock market? All right. We could see some of that data looking like that's potentially what has happened. When we see the deposits broken down between not seasonally adjusted and then seasonally adjusted. I hate everything that's seasonally adjusted. I hate that. It's a manipulation. I understand why they do it, because they want to manipulate. Anyway, the red line, that is not seasonally adjusted. And right now, we're seeing deposits starting to decline here at this time. And so that means they've got to go somewhere. And are they looking for safety? Well, if they're scared about the banks, they would. Is that what's going on? I don't know. At the same time, we have this looking at the BTFP, more and more and more usage. We haven't seen this level of usage, the surge, in fact, since these banks started failing. So we know that there is this real demand for that emergency program. And then basically just talking about the Federal Reserve, when they're going to cut. This is the big thing. March is everything. So keep an eye on that. Of course, on this channel, I will give you everything you need to know. Hit that thumbs up button to support the channel. And that also will make you more likely to be aware of the video I'll do tomorrow, which we're going to get into some really important details. If you want to get your situation in order, you've got some issues with your finances, you want a CFP or a fiduciary to look at your finances, and by the way, do so for free in a 45-minute call. I linked up with Money Pickle, and Money Pickle is going to be able to help you out, all right? So what you do is you go down to the link in the description and click on that one where, you'll be able to get Money Pickle to help you out. Interesting name they've got, and I like it. They've been helpful to the people who have signed up so far. I want to thank you very much for being here today, and I'll see you tomorrow. Take care.